Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kimberly-Clark Corporation Annual Report. Kimberly-Clark Corporation offers a wide range of personal care products under various brand names. The company's North America segment provides disposable diapers, training pants, baby wipes, feminine care products, bathroom tissue, paper towels, soaps, sanitizers, and other related products. In addition to these household use products, the International Personal Care segment offers baby and child care, adult care, and feminine care products, including disposable diapers, training pants, swimpants, and baby wipes. The company sells its products through various channels, including supermarkets, mass merchandisers, drugstores, warehouse clubs, variety stores, department stores, and online retailers. Professional use products are sold to manufacturing facilities, lodging establishments, office buildings, food service providers, and high-volume public facilities through distributors or directly. The company's product portfolio includes disposable diapers, training pants, baby wipes, feminine care products, bathroom tissue, paper towels, soaps, sanitizers, reusable underwear, swimpants, napkins, wipers, tissue towels. The company's brand names include Huggies, Pull-Ups, Goodnights, Codex, Poise, Depend, Kleenex, Scott, Cottonelle, Viva, and Wypal. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop. The decline of a company's stock price is often a complex issue with multiple contributing factors. One possible reason for a decrease in stock value is poor financial performance, such as declining revenue or profits. This can be due to various reasons, including increased competition, market saturation, or failure to adapt to changing consumer preferences. Another factor that may contribute to a decline in stock price is negative news and publicity surrounding the company. This can include scandals, product recalls, or other controversies that damage the company's reputation and erode investor confidence. Additionally, external economic factors such as recession, inflation, or changes in government policies can also negatively impact a company's stock price. These macroeconomic trends can affect consumer spending habits and business operations, leading to decreased demand for products and services. Lastly, internal management decisions and strategic mistakes can also lead to a decline in stock price. This includes poor leadership, inefficient resource allocation, or failure to innovate and stay competitive in the market. In summary, a company's stock price is influenced by a multitude of factors, both internal and external. Understanding these contributing elements is crucial for investors and stakeholders to make informed decisions about their investments. Kimberly-Clark Corporation market capitalization of $36 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Kimberly-Clark Corporation holds a significant advantage in their industry. Kimberly-Clark Corporation trades at a higher price-to-earnings ratio of 23 times and a higher price-to-book ratio of 24.23 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 94% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 4.67%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be attributed to several key factors. Unfavorable pricing has had a significant impact, resulting in a minus 5.8% decrease. Additionally, rising input costs have also contributed to the decline, with a minus 7.2% effect. On the other hand, volume gains have provided some relief, increasing revenue by 2.5%. Furthermore, organic sales growth has been steady at 1.7%, indicating a stable foundation for future growth. These factors have collectively influenced the net sales data, leading to a decline in Q3 and Q4 due to unfavorable pricing and input costs. The net income of the company experienced a significant decline between 2024 and 2025. The decrease was most pronounced in the third quarter, where it dropped by 21% compared to the first quarter. However, the fourth quarter saw a slight recovery, with a net income of $499 million, still lower than the previous year. The profit margins also suffered a decline during this period. The gross profit margin, GPM, decreased from 37.1% in the first quarter to 35.8% in the fourth quarter, representing a total decrease of 3.3 percentage points. Similarly, the operating profit margin declined by 12.9% in the second quarter and continued to drop throughout the year. The reasons behind these declines are not explicitly stated in the provided text. However, it can be inferred that the company faced significant challenges in maintaining its revenue and profitability levels between 2024 and 2025. The decline in net income and profit margins suggests that the company may have struggled with increased costs, decreased sales, or other operational issues during this period. To determine whether a company is generating positive operating cash flow, one must examine its cash flow statement. Unfortunately, the provided summaries do not include this crucial information. However, we can infer that the company's operating profit has been declining over the past 2 years, with a 12.9% drop in 2024 and a 0.8% decrease in the current year. This trend suggests that the company may be struggling to generate sufficient cash from its operations. To accurately assess the company's ability to generate positive operating cash flow, we would need access to its cash flow statement. The company's debt level and interest expenses have remained relatively stable over time. A $3 billion revolving credit facility with an average interest rate of 2.4% has been in place, supplemented by a $1.5 billion term loan. The use of derivative instruments to manage risk does not provide insight into changes in debt or interest expenses. Overall, there is no clear indication of significant fluctuations in these financial metrics from one year to another. Management is outlining a clear strategy to drive profitability through cost savings and productivity initiatives. The company has embarked on the 2024 Transformation Initiative, which aims to create a more agile and focused operating structure. This initiative includes cost savings, process improvements, and investments in innovation. The company is also taking steps to manage various types of risk, including foreign exchange, interest rates, and commodity prices through the use of derivative instruments. Additionally, management has implemented a supplier finance program that allows for efficient payment processing with participating suppliers. Overall, management's outlook suggests a focus on operational efficiency, cost savings, and strategic investments in innovation. These efforts are expected to drive profitability and position the company for long-term success. The company has been actively engaged in strategic transactions to shape its future growth. One significant acquisition is the planned takeover of Kenvue, a prominent consumer goods firm, which is expected to be completed by mid-2026. This move aims to bolster the company's market presence and expand its product offerings. In addition to acquisitions, the company has also been involved in divestitures. Two notable examples include the sale of its PPE business and the exit from its private label diaper business in the United States. These strategic decisions demonstrate the company's willingness to adapt and reposition itself in response to changing market conditions. The recent summaries have raised concerns about the company's ability to manage its supply chain effectively. One key issue is the decrease in supply chain-related investments by 100 basis points, indicating a potential bottleneck in the production process. Furthermore, the impact of tariffs on manufacturing costs has increased by 3.6%, while input costs have risen by -7.2%. These increases suggest that the company is facing significant challenges in managing its inventory and supply chain, which may lead to disruptions in operations and increased costs. That concludes the financial summary for Kimberly-Clark Corporation. Feel free to comment below, and I will be happy to answer them when possible.